Revenue versus profit. What's the difference? Part 2. Calculating revenue to profit. Companies begin their income statements by reporting revenue. They end them by reporting net profit. Several steps are involved in getting from one category to the other. The formula for calculating net income and each step in the process are: net profit equals net revenue cost of goods sold, operating expenses, interest expenses, taxes. Step 1. Calculate net revenue. This entails gathering all revenue sources and factoring in all appropriate items such as returns that directly reduce gross revenue. Step 2. Calculate the cost of goods sold, COGS. COGS is the cost of producing or purchasing the products that are sold during the period. It includes the cost of materials, labor, and other direct costs. These expenses are only attributable to creating inventory to be sold. They don't include administrative costs that are geared more toward operating a business. Step 3. Calculate gross profit. Subtracting the COGS from gross sales gives you the gross profit. Step 4. Calculate operating expenses. Operating expenses are those that are incurred to run the business. They include rent, utilities, salaries, marketing expenses, maintenance and repairs, and property taxes. These costs are necessary to run the business, but they're not necessarily correlated to the production of a specific good that's sold. Step 5. Calculate the operating profit. Deduct the operating expenses from the gross profit to arrive at the operating profit. Step 6. Calculate interest and taxes. Interest and income taxes are two expenses that usually aren't included as operating expenses. They're reported below operating profit, but they're still included when calculating net profit or net income. Step 7. Calculate net profit. Deduct the interest expenses and taxes paid during the period from the operating profit to arrive at the net income. Example of revenue versus profit. Amazon.com reported its fiscal year 2022 results in February 2023. The company generated $242.9 billion in net product sales and $271.1 billion in net service sales during the period. Both of these amounts include contra-revenue accounts such as returns, but the general direction of these accounts is to report only money earned before broader company expenses. The company's total net revenue was therefore $514.0 billion for the 12 months ending December 31st, 2022, even though the word sales is used on Amazon's financial statements. Analysts must review the expense side of operations to bridge from total revenue to total profit. Amazon spent over $288 billion on the cost of goods sold. The company had over $501 billion of total operating expenses in total, omitting expenses such as taxes or interest. Amazon reported $514 billion of revenue, but the company didn't earn a profit because it reported a net loss of $2.7 billion. This report highlights the importance of not judging a company's performance solely on its revenue. Some companies may report record levels of revenue though they have minimal or no net positive profit because of the cost structure and one-time expense implications. Other related terms. Accrued revenue is the same as unrealized revenue. It's the revenue earned by a company for the delivery of goods or services that customers have yet to pay for. Let's say a company sells widgets for $5 each on net 30 terms to all its customers. It sells 10 widgets in August. It invoices its customers on net 30 terms, so they won't have to pay until 30 days later on September 30th. August revenue will be considered accrued revenue as a result until the company receives payment from its customers. The company would recognize $50 in revenue on its income statement and $50 in accrued revenue as an asset on its balance sheet. The cash account on the income statement increases when the company collects the $50. the accrued revenue account decreases, and the $50 on the balance sheet remains unchanged. Unearned revenue accounts for money that's prepaid by a customer for goods or services that haven't yet been delivered. A company would recognize the revenue as unearned and wouldn't recognize it on its income statement until the period for which the goods or services were delivered if it requires prepayment for its goods. The bottom line. Revenue and profit are two very important figures that show up on a company's income statement. Revenue is called the top line. A company's profit is referred to as the bottom line. These two figures are very important to consider when making investment decisions, but investors should remember that revenue is the income a firm makes without taking expenses into account. You should account for all the expenses a company has, including wages, debts, taxes, and other expenses when determining its profit.